Hey guys, on this video, I want to talk to you guys about what's taking place right now, what's going on right now in the U.S. economy. And I want to give you sort of a warning to something to be aware of that you got to stay focused on and make sure you don't become a victim of as we go into the next several months and we get closer and closer to a possible mild recession that they've been talking about. Now, this warning is for us regular retail investors like me and you, like most people, right? Now, this warning is not going to be for the big investors, the companies and corporations, right? Upper 1%. But for most of us guys, this is a warning for us. And the warning is basically this, guys. Don't pay attention to the fear that they're putting out there in the news media, right? On social media. A lot of that is propaganda, guys, and it's designed to help that 1% get richer. It's designed to keep you and me struggling at the bottom and that 1% to get wealthier, right? When they put certain things out on the media, in the media for news to be seen by everybody, a lot of time, guys, they're just throwing that out there like carrots, right? Just throwing that out there for us to bite on them, right? So be careful about that, guys. Now, we know, granted, the interest rates are still going up and they're probably going to keep going up. Just recently, a couple days ago, former Fed Ben Bernanke came out with some paper that he wrote, and he said basically the Fed has to keep raising these rates. But that's just another thing. That's just another piece of propaganda that's being used to say, hey, get ready for rates to go up, be nervous, be scared. Listen, the federal funds rate we know as went from zero about a year and a half ago, 0%, now to about 5 to 5.25%. So we know that rates have gone up, right? We know that the Fed has raised the Fed funds rate 10 straight meetings in a row. We know that, right? We know that inflation has been really high. Last year at this time, inflation was hovering around 9% for the CPI. And now it's still high, still around the 5% mark for the CPI, a little bit lower for the core PCE, but nonetheless, we know inflation is still higher than they want it to be, right? The Fed wants inflation to be right around 2%, and we're still 4 or 5%, so we're still a ways from that, right? So we know all these things are happening, and we know that there may be a mild recession coming. We know that housing prices have gone way up. We also know that interest rates for mortgages have gone way up, or at least a lot higher than they were. We know these things have happened, right? But the one thing you got to be careful about, my warning to us is, don't be nervous. Don't be scared. For example, guys, this debt ceiling issue that is taking place right now, actually, about whether or not the Fed is going to raise the debt ceiling. Well, listen, guys, we know for a fact that the debt ceiling is going to get raised, right? It's always gotten raised. It's always gotten increased. The U.S. government has never defaulted on its loans, right? It's always been able to pay Social Security. It's always been able to pay its employees. It's always been able to pay the military. It's always been able to do all of the things that it needs to do. It's always been able to pay interest on its loans and things like that, right? So the debt ceiling has always increased. And guess what? It's going to increase again. They're going to raise the debt ceiling, the debt limit. They're going to raise it again. But if you watch the news and you watch TV, well, you think, oh my gosh, everything could shut down. The U.S. government could default on its loan and be nothing in 2 weeks. No, guys, that's not going to happen. But it's advantageous for the 1% to say those things and to get us nervous and scared and shuffling and shifting all around in the lower ranks, right? Us retail investors. But listen, guys, we know for a fact that the U.S. is not going to default on its loans. It never has. And in my opinion, I don't even know why they have a debt ceiling, because they always raise it. So why have a debt ceiling? I think the debt ceiling first came about in 1917 when they were trying to, make the government a little more responsible and hold them a little more accountable for their spending. Well, we know that the government spending is out of control anyway, and it's going to keep going that direction. It has to go up. So that's just an example of, guys, of how they will scare you and get you frightened into believing that maybe the U.S. is going to default on its debt. I'm here to tell you, guys, it's not going to happen. So my warning to you guys is, listen, don't fall for the okie doke. Don't fall for the propaganda. Hey guys, if you're getting anything at all out of this quick video, do me a favor, smash the like button. right? That helps the algorithm push this video out to more and more people. So the way not to fall for the propaganda is just to keep investing. Keep doing what you've been doing, right? Keep on dollar cost averaging, putting a certain amount of money into your accounts at a certain period, once a month, twice a month, 4 times a month, continuously. Keep going. Guys, if you were investing last year, the S&P was down 18-19%. It was way down, right? But guess what? The S&P is back. This year, the S&P is in the green or in the black. It's looking good, right? No longer in that red like it was last year. So my point is, guys, that is when you should have been investing. But if you had gotten nervous and scared and say, you know what, oh my gosh, everything is going to go crazy, I'm nervous, I'm going to pull my money out of the market. If you had said that last year, man, you would have missed out on some serious gains. When they're telling you to be scared and be fearful, don't be scared and don't be fearful. When they're telling you to be careful, oh my gosh, something's going wrong, well, guess what, guys? That's the time when ain't nothing going wrong. You just keep on doing what you're doing. Keep investing. Keep dollar cost averaging. Keep moving forward with your investment plan into those index funds, into that wide array of individual stocks or mutual funds, right? Keep doing what you're doing, guys. Don't let them deter you and make you nervous and scared and fearful and want to run out of the stock market, right? Don't do it. You want to make sure that you're steadfast in there and not going anywhere, guys, because I guarantee you right now, interest rates are going to keep going up, right? Because the Fed has already come out and said, and they'll probably come out here in mid-June, about 2 or 3 weeks from now, and say, hey, we're going to raise the interest rate by 0.25% again, or 25 basis points. And so when they do that, guys, you got to be ready to say, you know what, dig your heels in and keep on investing. Don't let them rattle you, because they'll try to rattle you. That's the whole point in the game, guys. The whole issue of the game, the whole game itself is to, when everybody gets fearful, everybody starts leaving the market, okay, now we're going to buy a bunch of things on sale, which is what happened last year, right? When the market dipped, the market being down so much last year, that's what happened, right? Everybody left the market. Oh, I'm scared. I'm not going to invest right now. I'm going to change my 401k investing at my job from 10%. I'm going to go down to 3% because everything looks crazy. That's what they want you to do. And I'm telling you, be forewarned. Don't do it. Right? When they say be scared, don't be scared. Invest more, right? Because you're buying things on sale at a discount when you're investing when the market is crazy or looks bad, or they're telling you to be scared, right? Now, the other thing to think about, guys, is labor. The labor market is super duper strong. The unemployment rate is 3.4%, guys, which means there's a lot of jobs out there and a lot of people are working. Okay. Now, when a lot of people are working, that means a lot of people are spending. And when a lot of people are working and a lot of people are spending, that means the rate that prices are increasing are going to take a little longer to go down to a lower rate, right? So inflation has remained pretty high. And part of that is this really strong labor market. Now, hey, that looks good and it feels good. But when the labor market is really strong, that doesn't do a lot to help inflation go down. So one thing you need to be considering, guys, is at some point the labor market won't be as strong as it is right now. At some point there'll be some job loss, right? The unemployment rate can't stay at a 50-year low of 3.4%. So the unemployment rate is going to ultimately rise at some point. It may go to 3.5% to 4% to 4.5% to 5% by the end of the year. At some point, it's going to happen. So you also want to make sure that you're preparing for that by making sure you have an emergency fund, guys. You have some cash. So not only are you not taking on new debt, right, and you're getting rid of some of that high interest debt, right? You're paying off those debts, but you also want to make sure that you have a stash of cash, right? An emergency is not just the tires going out on the car, right? An emergency is not just something small like that that's $500 or $600, but sometimes an emergency could be a job loss. And at some point, guys, that may be down the road, so just be thinking about that now. But again, don't be nervous. Don't buy into that propaganda that says you have to be nervous, you have to be on pins and needles, you have to be scared, you have to be watching out around, and you got to be anxious and losing sleep, right? And stressed out. You don't have to do any of that, guys. Do what you've been doing. save you up some cash, make sure you got your resume tight, and that, you know, you got your skills right, so that if something does happen and the job market gets crazy, you're ready. And make sure you have some emergency money, right? And keep investing. Keep doing what you've been doing. Don't pull back. The market may have already hit its bottom, right? It may have peaked at its low. Now, if it did, I'm sorry. You might have missed out on a lot of money. But if you didn't and you kept investing, congratulations to you. You did the right thing. So hey, just something to keep in mind, guys, that I want to share with you guys about investing, about what you should be doing, and just a warning to you guys to say, hey, don't allow them to rattle you, right? You keep doing what you're doing and you'll be fine when it comes to investing your money. I appreciate you guys for tuning in. I appreciate you guys for supporting the channel, and I appreciate you guys for supporting this growth, right? This channel continues to grow, and it wouldn't do so without you guys. So thank you so much, guys. I really and truly appreciate it. Guys, my goal on this channel is to break some of this U.S. economy stuff down to you in plain language so it's easy to understand. And I also want to help you do the right things to grow your money, to say, how can I take advantage of the markets? How can I actually grow my money while the 1% are growing their money too, right? I don't want to just be stuck with all the retail investors who are just reacting to the market. No, I want to get in there and do the things that the people that really make money in the market, how do they make money? That's how I want to do it. So it's one thing to be a good grower of money and a good investor of money, but I also on this channel want to help you guys be a good manager and a good steward over your personal finances, right? So hey, I hope you guys got something of value out of this quick video. Do me a favor, guys, smash that like button, subscribe to the channel if you're not already a subscriber, and also do me a favor, turn your notifications on and share the video. Hey guys, the best person to take care of the old you is the young you. Take care of yourself and take care of other people. Until the next video, peace.